Hello everybody and welcome to my channel. In this video, we are coming to look at the top 10 financial functions for accountants and finance professionals. So we know that Microsoft Excel is a productivity tool that is designed to enhance productivity at various sectors. And in this video, we are coming to look at how Excel can be useful in calculating certain financial metrics in the financial sector. Alright, so in this video, we are coming to look at the top 10 financial functions that every accountant or finance professional should master when dealing with any financial data in Excel. Alright, so we are coming to look at the XNPV, we are coming to look at the yield function, we are coming to look at the DB or the diminishing balancing returns, depreciation function, we are coming to look at the future value function, the NPV or the net present value function. We are coming to look at the IRR or the internal rate of return. We are coming to look at the XIRR. We are coming to look at the straight line method of depreciation, the interest payments on a security, and then finally we will look at the T-bill yield function. Alright, so let's dive into each one of them, and then in each of these functions we'll look at what they measure, what the values mean, how to calculate them, the syntax, and then we'll look at a case study or a case scenario. Alright, so we'll first start with our NPV, which we'll have live here. Alright, so what does the NPV do? So the description, seeing that the NPV calculates the net present value of an investment by using a discount rate and a series of future payments. Alright, so and the future payments, we are talking about the initial investment and then the projected future values. So the syntax for NPV is we have rates, we have value 1, value 2, like that. So it is the rate of return or the discount rate. And then so let's look at how we actually explain them here. So the rate is the rate of discount over the length of the period. And then the values are the projected future cash flows. Okay, so let's look at a use case. So we have an investment here with an initial investment of $40,000 with projected cash flow for 5 years. So we are coming to look at how to calculate the NPV. So the net present value of this investment with an initial investment of $40,000 with its projected cash flows, as we can see, can be calculated as follows. So we have equals NPV. Then the first argument or the first argument of the syntax is the rate. So what is the rate of the investment? We are talking about 9% right here in cell D2. Okay, then the values, future values or the future cash flows are from cell A3. So I'm going to select A3 and holding my shift key plus the down arrow, I will select the rest of the future values. I'll close my parentheses and then I'll add the initial amount, the initial investment, which is 40,000. So I'll add it and hit enter. And this is the net present value of this particular investment. So what this means is that when I discount the projected cash flows I am expecting to derive from this investment and discount it into the present, I would have this amount, $729.85. So this is how much I'll get from my investment in the first year. Alright, so let's continue. So this is how we calculate the NPV value in Microsoft Excel. Then we move on to the XNPV. The XNPV calculates the net present value of future cash flows that are not necessarily periodic. That means that when we look at the NPV, we see that we are having yearly returns. But with the XNPV, we can have returns for 6 months, we can have returns for 8 months, we can have quarterly returns, we can have semi-annual returns and all that. So the period is not necessarily periodic. You can have anything, and then so the XNPV is more robust than the NPV function. So that is simply, so this is how we calculate for the NPV value. We have equals XNPV, now the XNPV, and the first argument is the rate. The rate is the discount rate, 7%. We are assuming 7% for our use case. And then the values. So the values are, we are going to select from the initial investment. Holding my shift, I will select the entire cash flows. And then comma. Then the dates. I was asking for our dates, so I will also select my dates. So holding the shift and down arrow, I'll select the entire date, close my parentheses, and hit enter. So let's format this value nicely. It's actually currency. So this is our net present value for these investments with irregular periods of cash flow. So this is how we use the XNPV for our financial analysis. Okay, then we move on to the IRR, or the internal rate of return. The IRR, or the internal rate of return, is a popular accounting ratio that is used to calculate the return on investment in any project. Okay, so what is the IRR? Let's see if we have the description here. Okay, so the description is here. It returns the internal rate of return for a series of cash flows represented by the number in value. These cash flows do not have to be even. So we have that. Then the syntax is only two. So we have the values we are intended, or the cash flows we want to gain from our investment, and then we'll guess a discount rate. So we are going to calculate a series of them. So we have X. So the syntax is equals IRR, and then what are our values? So the first one we are calculating here is the investment's internal rate of return after 4 years. So we want to look at after 4 years. So the initial investment is not counted as part of the years. So we are looking for the first 4 years. So I'll select the first 4 years of our cash flows. And then I'll close my bracket and hit enter. Now I didn't use the guess rate because the guess rate is actually an optional syntax requirement. It is not required. It is optional. Alright. Then the second one I want to calculate is the internal rate of return after 5 years. So we have equals IRR, and we select it from investments, initial investments up to the 5th year. Close my parentheses and hit enter. Okay, so that is 8.66%. And then we want to calculate the correct this. So we want to calculate the internal rate of return after 2 years, and this time you are going to make use of a guess rate of 10%. So we have equals IRR, and we want to look at 2 years. So the first 2 years, comma, and what is our guess rate? Our guess rate is 10%. Close the parentheses and hit enter. Okay, so what is the guess rate, or what does the guess rate do? The internal rate of return is actually the rate of return that will bring our net present values, or the cash flows projections discounted into the present, to zero. So that is actually, it is a technical ratio in accounting, and it is used for investment purposes, whether know uh, to know whether an investment is profitable or unprofitable. Okay, so that is why we make use of guesses to see which rate of investment will actually bring our cash flows, or our net present values, to zero. All right, so let's come to the XIRR, which follows a similar logic as with the NPV. So we have irregular cash flow periods. So in this situation, we have 1st January 2022, then we have 1st March, 3 months later. We have 30th October, that is 6 months later, and then we have 15th February, and then 1st April 2023. So this is irregular periodic cash flow projection. So it is equals XIRR, and the values we are looking at are these. So holding my shift, select everything, comma. The second argument is the dates. So come here and select my dates. Select my dates, hit comma, and our guess rate is 10% right here. So I'll close my parentheses and hit enter. So this is, let me format it as a percentage and increase the decimal values to 2. Alright, so this is our internal rate of return. So this is just giving us a general overview of what the IRR, how the IRR is calculated in Microsoft Excel. So this is how we calculate the internal rate of return within Microsoft Excel. We can use the IRR, where we have a series of payments, or a series of cash flows. And then we can also use the XIRR, where the payment not necessarily periodic. Alright, so let's move on to the future values. Now, you may want to make a projection of what that investment is going to give you in the next future. So that is where the future values function comes in. So we want to know how much investment, how much returns an investment is going to make in the next 5 years, in the next 10 years, in the next 15 years, or something like that. Okay, so that is where we have the future cash flows. So to calculate future cash flows, we have equals. Right, so let's look at the syntax. The syntax is the rate, the number of periods, the payments, present value, and then, so let's look at them. The rate is the interest rates per period. That could be the it could be the inflation rate, or the rates on the interest rates of governments, or anything. Then we also have the number of periods. That's the total number of payments periods in annually. Okay, so we also have the payments. How much payments are we making per period? And then we also have the present value, the amount of money we want, that is the present value, or the lump sum amount that a series of future payments is worth right now. So if we omit the present value, it is assumed to be 0 and must be included in our calculation. Okay, so let's see how the future value, so equals FV, that is the, so we have the rate. The rate in our scenario is 11%, and the number of payments is 35 times. The payments we are making is $2,000 negative, and the present value. So the payment is due at the beginning of the year, so we are going to use 1. And what is it going to be at the end of the period or at the beginning? So we want at the end of the period. So I'll select I0 and then I'll hit enter. So this is our future value. Then we come to yield. What is yield? Yield is the returns on a security with a periodic interest payment. The yield on a security with periodic interest payments. So the syntax has the following arguments. So first of all, we have our settlement. The settlement is talking about the date on which the security is traded to the buyer. So that is our settlement date. Then there's maturity. The maturity date is the date when the security actually expires. Then we also have the rate. The security's annual coupon rate. That is the rate. Then the price. The price is per $100 face value. We have the redemption, which is the security's redemptive value, also per $100 face value. We have the frequency. How frequently is the interest payment made? So is it semi-annual, is it annual or quarterly? And then we also have the basis, which is actually optional. Okay, so let's see how we can calculate our yield for the data we have. So we have yield equals yield. So we have equals yield. And then we have our settlement date right here. We have the maturity date, which is 1st January 2030. We have the rate or the annual coupon rate, which is in our case is 8%. We have our price per $100, so you put it at $93.25. We have the redemption value, which is 100 per $100 face value. The frequency, what is the frequency? So we want to select semi-annual. So semi-annual, which is 2. And then the frequency, we want to select the US NASDAQ, which is 30/360. So let's select that, which is 0. I'll close my parentheses and hit enter. So this is my annual yield on this particular security in 30 years time. Okay, then we go to our T-bill or the treasury bill yield calculation. Okay, so we come to the treasury bill yield calculation. So this is how we calculate the returns on a treasury bill in Microsoft Excel. So the syntax is settlement. We have settlement and then we have maturity date. So we have the settlement date, the date on which the buyer buys the security. The maturity date, the date on which the treasury bill expires. And then we also have the price of the treasury bill. All right, so let's see how it's calculated. So we have equals T bill yield. That's it. So you have the T bill yield. The first argument is our settlement date. So I'll select my settlement date, comma. I will select my maturity date, comma, and then my price, the price of the treasury bill. Close my parentheses and hit enter. So that is the yield on the treasury bill. So this is how we calculate the treasury bill yield. Very simple. We have the settlement date, the maturity date, as well as the price of the T-bill. Now we have another popular finance function in Microsoft Excel called the interest payments. The interest payments function. So what does the interest payment function do? It returns the interest payment for a given period for an investment based on periodic constant payments and a constant rate of return. So what is the syntax? The syntax is we have the rate, we have the period for which you want to find the interest. We have the number of periods in a year. Then we also have the present value and then the future value, which is optional. Okay, so let's see how we calculate the interest payments based on the data we have here. So we have equals IPMT, and the first argument is the rate, and this is A12. But the first one we want to calculate here is the interest due. So as we can see here, the interest due in the first month for a loan with terms in, okay, so the first month. So this is our interest. If we want to get, the interest is annual per year. So if we want to get per month, we would have to divide it by 12 months. Okay. Then the next one is the period for which we want to find the interest payment, and that is 1. We have it there. Then we also want to know the years, the number of years of the loan, and that is years, right here. And then the present value of our loan is 10,000. We'll close our parentheses and hit enter. So that is our interest payment per month. And then we also want to look at the interest due in the last year for a loan with the same terms where payments are made yearly. So this one, the first one, we look at the monthly payments. This one, we want to look at the yearly payments. So we have equals IPMT. Our rate in this case is annual, so we are going to use the entire thing. For the number of periods is 3 years. Then we have so the number of period for the loan is going to be 3 instead of the 1 we have here. And we want to look at our number of periods, which is 3, and then also our present value. I'll close my parentheses and hit enter. And this is the interest payment we will be making. This is the interest payment due in the last year for a loan with the same terms of payments. Okay, so that is it for our interest payments. It is a very common financial metric in finance. Alright, so we also have this function for calculating the fixed depreciation rate for an asset. Okay, so this is we call it the DB, or the diminishing balance, using a fixed amount yearly. So the value of the assets reduces yearly by a fixed amount, and this is slightly different from the straight line method of depreciation, as we will see in our next, which is the next function we are going to look at. Okay, so what is the syntax for this? We have the cost of the assets, the initial cost of the assets. We have the salvage, or the what we call the scrap value, or the residual value. We have the useful life of the assets. We have the period, and then we also have if it is on monthly basis, a monthly depreciation, which is optional. Okay, so let's see how we are going to use this function to calculate depreciation for first year with only 7 months calculated. So it means that for instance, the financial period started from May, and so the number of periods, or the number of months in that first year, is going to be 7 months. So we have equals dB. So as you can see, it returns the depreciation of an asset for a specified period using the fixed declining balance method. Okay, so that is what the dB does. It uses the fixed declining balance method to depreciate an asset yearly. Okay, so we have the cost. What is our cost? It is $5 million. The salvage or the scrap value is 700,000. That is the amount you are going to realize the asset at the end of its useful life. The useful life is 6 years, and the period for which you want to return the asset is 1 year, and then the number of months is 7. So I'll close my parentheses and hit enter. So at the end of year 1, within 7 years, we are going to depreciate the asset by $813,750. Then at the end of year 2 is going to be dB, the cost of the assets, the scrap value or the salvage value, the number of the useful life of the assets. The period we are looking at is 2 years, and it's going to be 7 because the first year was 7 months. The 7 months will continue to hold. So we close our parentheses and hit enter. So that will be our depreciation for the second year. Now in the third year, it's going to be the same thing, dB, and we have our costs, we have our scrap value, we have our useful life. The number of periods is 3, and we want to depreciate by 7 months again. Close my parentheses and hit enter. Our fourth year is gonna be dB, our initial cost, the scrap value, the useful life. The period is 4. It's 7 months. Close my parentheses and hit enter. We have equals dB. For the fifth year, is going to be the cost, the scrap value, the useful life. Number of periods is 5 and 7. Close my parentheses, hit enter. We have dB. We have the cost of the assets. We have the scrap value. We have the useful life. And we have the period to be 6 and 7 months. Enter. Again, for our 7th year, with only 5 months, so it's going to be equals dB, the cost of the asset, the scrap value, the useful life. The number of periods is 7 with only 5 months. So I'll hit enter. And this is how the fixed declining balance method of depreciation is calculated in Microsoft Excel. Okay, so then the last function we are coming to look at is the straight line method of depreciation. So the straight line method of depreciation is actually the most commonly used depreciation method in accounting. And what it does is that we have the cost of the assets, we subtract the scrap value or the salvage value, and then we divide the result by the useful life of the asset. It is a fixed method of depreciation, and it reduces the value of the asset, the cost of the asset, over its useful life by a fixed amount. Okay, so this is how we calculate it in Microsoft Excel. So I hit equals, then the function is SLN, and as we can see, it returns the straight line depreciation of an asset for one period. So I'll select it, and the first argument is the cost, which is 50,000 in our case. The salvage value is 12,550. That is the value we realize for the asset when we sell it at the end of its 12-year period. Then we have the life of the asset, which is 12. So I'll close my parentheses and hit enter. So this is our depreciation. This is the depreciation of the assets to be charged in our profit or loss account, and also subtracted from the cost of the asset in the statement of financial position. Okay, so this brings us to the end of our lesson for today. So in this video, we have looked at the top 10 financial functions that are very useful for financial accountants and finance professionals. So we looked at the net present value using one with fixed payments, where we use the NPV, and then one with non-periodic payments, which we use the XNPV. We use the IRR, or the internal rate of return. We use the XIRR, where each of these functions are used in finance. And we also looked at the straight line depreciation. We looked at the interest payments function. We looked at how to calculate the yield on a treasury bill. We also looked at the future values of an investment. And finally, we also look at the yield on a security or an investment. Okay, so this brings us to the end of the video. I hope you liked it, and I encourage you to subscribe to the channel. And then I'll see you in the next video.